Hello there. So you've sold a rental property in the UK? That's fantastic news. But with that profit often comes a pretty complex tax headache. Well, don't worry. In this guide, presented by the experts over at My Tax Accountant, we're going to break down capital gains tax and a really important relief that could end up saving you thousands.
Okay, let's kick things off by jumping into a situation that, well, countless UK landlords know all too well.
You know that feeling, right? You've had a successful sale, you're looking at the profit, and then that sinking feeling hits when you realize a big chunk might be going to the tax man. It can be super stressful, but honestly, just understanding your options is the very first step to getting it all under control.
Right, so to get a handle on that tax bill, let's get really clear on the key terms you absolutely have to know, and we'll start with the tax itself.
So, capital gains tax. The most important thing to get your head around is that you only pay tax on the profit you make, not the total sale price. And the good news is, everyone gets a little tax-free allowance to start with. Right now it's £3,000, before that tax even kicks in.
Now here's where it gets really interesting. Let's talk about something called letting relief. You see, if you actually lived in that property before you started renting it out, this could be a massive financial lifeline for you. We're talking about potentially saving you thousands. But, and this is a big but, there's a catch. And yeah, it is a big one. This is where things can get a little tricky. There was a huge rule change back in 2020, and honestly, it's tripped up a lot of landlords who just weren't aware of the new way things work.
And you can see just how stark this change is. Before 2020, the rules were much more generous. But today, you only qualify for this valuable letting relief if, and only if, you can prove you were sharing the property with your tenant. So, if you moved out completely and just rented the whole place, that relief is, I'm afraid, no longer on the table.
So, with that really critical new rule in mind, how on earth is the final tax bill actually worked out? Let's walk through the whole process step by step.
The calculation really follows a pretty clear logic. You start with the big number, your total gain, and then you systematically chip away at it. First, you deduct any allowable costs. Then you apply any of those crucial reliefs you're entitled to. It's only after all of that's done that you take off your tax-free allowance to get to that final taxable figure.
Okay, theory is one thing, but let's make this really concrete by looking at a real-world example. We'll call her Sarah, a teacher, and her situation is the perfect way to see how these rules actually work in practice.
So first up, we need to figure out her total gain. The sale itself made her a £200,000 profit. Great! From that, she can deduct £15,000 in what we call allowable costs. We're talking about things like estate agent fees, solicitor costs, maybe some capital improvements she made along the way. That brings her initial taxable gain down to £185,000.
Okay, next up are the reliefs, and this is where it makes a huge difference. Because the flat was her main home for a while, she gets something called Principal Private Residence Relief. And, crucially, because she then shared the property with a tenant for 3 years, she also qualifies for letting relief. Put those together, and they slash tens of thousands of pounds off her taxable gain.
And here it is, the final number. After applying all those reliefs and her annual allowance, Sarah's final tax bill comes to just over £15,000. Now, to put that into perspective for you, if she hadn't correctly claimed that letting relief, her bill would have been over £22,000. That's a saving of more than $7,000 just by understanding the rules properly.
So, Sarah's story is great. It shows you what's possible when you get it right. But it also really highlights just how easy it is to make some very costly mistakes. So let's have a look at the most common pitfalls you need to avoid.
These are the errors we see time and time again. Forgetting that 60-day reporting deadline, that can lead to immediate penalties. But honestly, the biggest mistake is just assuming the old letting relief rules still apply. And if you don't have the records, the paperwork, to prove you shared the property, HMRC will almost certainly reject your claim.
Okay, so this brings us to the final and probably most important part of all this. How to apply this knowledge to your own personal situation.
It really all boils down to one simple question you need to ask yourself. Is my situation completely straightforward? You know, if you have multiple sources of income, or if the property's ownership history is a bit complicated, then you really need to proceed with caution.
Look, while this guide from My Tax Accountant covers the main points, every single property sale has its own quirks and nuances. Getting professional advice is, without a doubt, the safest way to make sure you're totally compliant, while also maximizing every single relief you're entitled to.
And for that kind of tailored expert advice, the team at My Tax Account is ready to help you navigate your capital gains tax obligations with total confidence. It's really worth getting the advice you need to make sure you don't pay a single penny more in tax than you absolutely have to.